Hi, Brendan.
Sorry, how are you, mate?
Good, how are you? Sorry, we're live, but it's just making sure everyone's coming in.
No problem. Live with clients?
Yes, live with clients.
Excellent. Well, a big welcome to all our clients and to another investment and market and performance update with obviously our very own Tom Schubert. How are you, Tom?
Very well, thanks, Brendan. Good to be back.
Yeah, absolutely. And obviously, just as a reminder for our clients and those who may be new to joining these webinars, we like to make it as interactive as we can. At the bottom of your screen, there is a Q&A tab. So if you do have any questions along the way for Tom or myself, please just type it in and we'll obviously endeavour to get to those. But with that, I'll hand it over to you, Tom.
Thanks, Brendan. Congratulations on back-to-back nominations for the IMAP Awards this year as well.
Thank you, and likewise. It's a mutual admiration society here, mate. You obviously did very well and got on again. Third time, I think, isn't it?
Yeah, we're happy. Thank you.
Well done. Hopefully we can, between the two of us, we can take home a win.
That'd be nice.
Good on you. Thanks, Tom.
We'll kick things off. Thanks, Brendan. A usual disclaimer. So yeah, we'll dive straight in and just look at performance of the portfolios, and then more broadly just performance of markets this year. The Magnificent Seven, as they're now being coined, the big tech stocks come up with all kinds of different acronyms and names, and that's the latest addition. We'll have a quick look at global growth and how we're trending. And then there's a lot of debate in the press, in markets, around, are we heading in for a soft landing, coming out of last year's all the rate hikes and inflation moderating? Is it going to result in a soft landing, or are we heading for a recession? And so we'll unpack the sort of both sides of that story. Actually, we'll take a look at some of our long-term scenarios, which we updated again this year as part of our strategic asset allocation review, including artificial intelligence, and I'll sort of discuss the impacts both from a long-term economic perspective, but also from a shorter-term investment perspective and what we're looking at. We'll recap on equity markets, valuations, earnings, etc., and how portfolios positioned, and then in particular we'll take a look at the sort of yields available now in the defensive parts of the portfolio, which have become a lot more attractive and have become a bigger component of the portfolios of recent times. Let's just recap on performance. So this is to June 30. July numbers, the audited numbers have come through today, so they'll be published later today. But in essence, flat on the month, reasonably flat on the quarter versus the institutional peer groups. And really, like, the one-year number is reflective of this kind of six-month number. We last year were quite conservatively positioned in portfolios. It was pretty well flagged early on in 2022 that we were concerned about the outlook for markets, which were expensive in the face of higher and more persistent inflation, and what that was meaning for interest rates. And we'd adopted a more conservative position, and as a result, that was a good position to be in last year in terms of minimising the drawdown in portfolios. And we went into the end of the year still holding a relatively defensive position. January was a big surprise month. China reopened from zero COVID. There was a number of, there's a bit of stimulus or potential stimulus that came out of the US again, another surprise. And markets had an incredibly strong month, translated really to a strong quarter, and we underperformed during that quarter, just not quite. We participated, but just not to the same extent, given the relative cautious positioning. And since that time, and I'll step through later through the pack, through March really through to June, we have increased equity and growth exposure within portfolios, and it's kind of reflective now of the portfolios largely keeping up with that appreciation. So it was really just a quarter where we didn't quite have enough risk on relative to the peers, as a result of how we were positioned to protect capital last year. But in essence, long term, since inception, still continuing to outperform that peer group, and that quarter is in the rearview mirror. On another comparable basis, the industry super funds like Australian Super delivered 8% for the year, which is kind of comparable to the high growth risk profile, which is about 80% growth. So their high growth or their balanced growth, as they call it, is a similar risk profile, and delivered a similar outcome, so kind of in line over the financial year to June. Also, in absolute return terms, still pretty healthy returns from portfolios, it's fair to be said. So this year, and you can kind of see it a little bit here, this is looking at calendar year to date returns across major markets. And so we can start really see the dark line here, which is global equities have been the driver, and we'll unpack that a little bit further. It's primarily driven by the big tech stocks again. One, they had a bad year last year, so there's some recovery off those lows. And secondly, just in particular, the ones that are exposed, or at least the perception of being exposed to the artificial intelligence boom that's taken place this year. But other markets, look, Australian equities in the yellow, they started the year okay. They're up during January, but really since that time have been flat. So, the slowing Australian economy, so higher interest rates are impacting us more. Resources have been under pressure. China has really slowed down recently. And so those two big drivers, banks and resources, haven't really done much. And as a result, Australian equities are actually largely flat. So it's really been a few big tech stocks lifting the broad market higher this year. Defensive assets, on the other hand, it's a bit of a mixed bag, but not as bad as it was last year in a lot of bond markets, and we've started to see some positive returns, I guess, out of those assets, which is good. And the pink line, the best performer being currencies. The Aussie dollar's fallen a bit this year, and that's driven, that's helped global equities in unhedged terms. Let's talk about the Magnificent Seven, as they're now being coined. This is Facebook, which is Meta, Amazon, Apple, Microsoft, Google, Tesla, and NVIDIA. NVIDIA makes the chips that are in, deliver essentially computing power through servers, data centers, processing power within computers, and a lot of chips within, cars, etc. And so quite a critical part of the infrastructure required. They've also got some unique software and capabilities around AI, and they delivered a big earnings upgrade a few months ago, which has spurred a rally more broadly in any business exposed, if you will, to AI. And we'll talk a little bit about ChatGPT in a minute, but essentially, this technology has been bubbling away in the background for some time. But through the evolution of ChatGPT, we've all sort of heard about it all of a sudden, and it's created quite a bit of frenzy around trying to get exposure to that investment theme, if you will. And so that's really lifted those large cap tech stocks to be up close to 20% for the year. So that's the US market. If you strip out those big names, it's sort of only 9%. So a big piece of the return has come from those tech stocks. And it's really only since May that the market has broadened. And so other sectors up until that point really hadn't done anything all year. And so now we've started to see some broader participation in US equities at least. And that's given us some confidence in, potential for a soft landing narrative carrying on, which we'll talk about a little bit more. But the other important point to note is the composition of that return. Not only has it been very narrow, it's driven by only 7 stocks, or primarily by 7 stocks. It's all been driven by valuation expansion, which is the blue line here, and the red line is earnings. It's actually earnings in the US have been declining all year. And so all of the appreciation in prices just a valuation expansion. So they've just got more expensive. And that's a relevant point, just given, expectation for further returns from here are muted, because ultimately you need earnings to be driving stock prices, they can't just expand in terms of their valuation. So global growth, after you can see actually that sharp rebound I spoke about earlier, this is January, and that light blue line is Asia. And so that's the big spike from China reopening after really struggling for a period of time. And now it's absolutely declining. In fact, the data in China is getting worse and worse and worse. I was up in Asia and Hong Kong last week, and on the ground, it's fair to say they're facing quite a few challenges. The impact of the slowing housing market, retail sales are falling, exports are falling. So one of the things that kept China afloat as they were locked down and struggling under the weight of, problem property sector was that the global rest of the world was open and we were all buying lots of goods, as we know, driving inflation. And so China obviously exports lots of goods to the world. And so exports are really buffering their economy against the other domestic facing issues. Now the rest of the world is slowing down and the consumers globally are, they're facing higher interest rates and spending is slowing. We saw actually export data in China collapse last week and down almost 18%. And, so they're facing dual headwinds now of both domestically, the economy slowing and confidence low, but also, the global economy now we can see is starting to slow in aggregate as well. So we're trending down in terms of growth. And so, that leads us to the question, is this, a cyclical decline like we've seen before that will rebound, or is this us heading into a more deeper, prolonged recession? And so that's the big question facing, us and investors at the moment. So in the
sorry, just before you move on with China, obviously we've got the resources side of things. Is there any other Australian companies that will be negatively impact due to China's headwinds that they're facing?
It's interesting. It's a good question. So because of ordinarily, I would say yes, things like treasury wines, tourism, etc., really would be feeling the impact. However, given trade tensions of the past few years, those stocks and businesses have already felt the effects of the higher tariffs or bans on trade, Australian goods trading with China. Their closed borders meant that we haven't really seen the influx of tourists come back like we saw before COVID. And so versus where we are today, probably less so, to be honest. And we're seeing the iron ore price fall. We are seeing some impact. Like, it's not positive for Australia, but to the extent that we've probably worn some of that pain over the last few years through those trade tensions and issues anyway, and borders being closed, it's probably less of an impact versus where we were pre-COVID, if that makes sense.
Yep.
Still obviously a negative, still a huge export market for us, still a big component of growth. It's another headwind facing the Australian economy, which is really struggling under the weight of higher interest rates and high levels of household debt. So, it'd be nice if China was doing well to kind of help offset that, but we're actually facing, two kind of headwinds in that sense as well.
Yep. Thanks, Tom.
Is it a soft landing? So the chart on the left is the yellow line is the manufacturing sector activity. We call it the ISM in the US. And so this is looking at all the activity in the manufacturing sector, which is quite cyclical, tends to move in sort of 18 months up waves, 18 months down waves. That's the kind of global inventory cycle in manufacturing. And you can see, obviously, it's in a down cycle at the moment, but the new orders subcomponent, so they interview the purchasing managers within big companies and say, well, what are your intentions? Are you buying, are you going to order more or less relative to the stock that you're currently holding? And that tends to be quite a good leading indicator for the cycle within that sort of short cycle within manufacturing. And so we can actually see a tick up there in new orders. So potentially there's we're cycling down, but there may be a little tick up in the manufacturing cycle in the US, and that's positive. So that's something that we are keeping a close eye on.
So sorry, Tom, is that a real leading indicator as to how economies will perform in the coming months?
Yeah, it's a bit of a leading indicator on growth, essentially. And so if it has cycled quite low, but it is bouncing back, and that is a positive. And so definitely, we'd like to see that then reflected in the actual ISM itself. And if that starts to bottom out, that's probably indicative that it's just been a bit of a mid-cycle slowdown, and we may see a cyclical recovery in the US economy. And so that's a positive. But it's not, it's something we're watching closely, I guess. We want to see the evidence, but it certainly, lends itself to the soft landing camp. That piece of data. On the right-hand side, the other key positive is looking at inflation. And so we're probably all aware that headline inflation has been trending down and continues to trend down. And that's a positive in the sense that it probably means we're now at the peak of the global rate hiking cycle. So, RBA at 4.1, Fed's at 5.25, US, that is. Then you may get one more out of the US, you may get one more out of Europe, but you're basically there. We're done. I think we're probably done in Australia. And so we're at the sort of peak in the inflation cycle, which means we're peaking rate cycle, and that's a positive for growth going forward.
Where is the Australian inflation rate as we speak, Tom?
It's still a bit stickier. We're sort of still in the high threes, which is, they've got to get it down into the 2 to 3% band. And look, the US, to be fair, is still above 3 as well. So we're not there yet, but the trend is down. Again, areas we're watching quite closely are some of those subcomponents. So wages tend to be stickier. So we're looking at wages growth. And so public sector wages growth in Australia came out yesterday as showing signs of moderating, but the private sector payrolls growth was actually, and wages growth was actually elevated. And so in the US, similarly, wages growth is running north of 4. It's hard to see that then translating to, an inflation rate of 2%, which is where they're trying to get to. And so we do need to see, food prices, energy prices have come down, rental growth has slowed down from an inflation perspective. Wages growth has moderated, but we do need to see, it needs to keep falling basically. Like if it flatlines at 3.5%, they're clearly going to have to raise rates more because that's above target. If it keeps falling below 3 into that 2 to 3% range, then their work is done. And so we want.
Sorry, Tom. So it only feels like 5 minutes ago that inflation was pegged at 7%, but are we saying that the rate hikes have done their job in the short term, but we still want to see that continue to fall?
That's right. So the impact of, they've done the 4% in Australia and the 5% in the US is really starting to cool demand and cool. And we've seen probably because of slowing growth in China, commodity prices have softened, etc. Like that's all helped come off peak oil, from some of the issues around the war inflation from the start of last year in food. And so, risks around this are the fact that we are seeing a conflict between Ukraine and Russia be elevated again. They're bombing food supply ships in the sea. Heading into Northern Hemisphere winter, oil prices, etc. So there's some risk around that. And they're things that we watch. But at the moment, it looks like the trend is certainly in favour of, getting that inflation number to target and under control. We're watching wages and we're watching commodity prices. They're the two big things that could sort of break the trend down. And then that means, rates are going to have to keep rising.
A lot of our clients have been enjoying the rate hikes, and we'll talk, obviously, I know we're going to talk a bit later about how we'll benefit from that in the portfolios.
Yes.
From this point, we're sort of expecting rates to, if they don't go up, are we expecting them to stay higher for longer? Is that the story?
We think so. Big picture, we think the environment is now in such a state. There's some big long-term trends like demographics. So people retiring and spending money and not earning anymore is somewhat inflationary. Defence spending is inflationary and it's going up everywhere as a result of geopolitics. Decarbonisation, spending money on renewable energy infrastructure is inflationary because it requires a lot of raw materials. Deglobalisation, people are reorientating their supply chains away from dependency on China. All of those things are somewhat inflationary over time. They're headwinds, not tailwinds. And so we think that the next decade, if you think about the decade post GFC, they'll really printing money and cutting rates to try and get inflation up to the target band, 2 to 3%. Mm-hmm. We think the next decade is, now is they're actually spending more time trying to defend the top of that band. And so that means it's unlikely to see, unless you get a really bad recession, like a lot of rate cuts coming through because they're worried that inflation will re-accelerate. They want to contain it at these levels, and given those headwinds, that's a struggle. So it's unlikely to see, material rate cuts coming through, absent a big problem in the economy.
So the defensive portion of our portfolios that have been obviously, it's been challenging, and obviously the growth side has had to do a lot of the heavy lifting over the last decade. We're hoping that will turn around a bit, and the defensive will take a bit more of the hit and produce a bit of a better result going forward. That's our hope.
Absolutely. I mean, we'll show you later on the returns from
Yeah.
the defensive part of the portfolio, but yeah, they've certainly considering now we're getting back to inflation at 2 to 3, not at 6 or 7. We're earning 6% on the defensive part of the portfolio. Like we're getting paid real income again.
Decent return for a change. Yeah.
Great.
From that
Even
portion.
after inflation.
Yeah. Importantly. All right. Thanks, Tom.
That's okay. So, in the recession camp there's a lot actually that still sits in there, and that is a lot of the, historical reliable indicators are basically flashing that they're, likely to be a recession in the US. Lots of surveys, leading indicators, yield curves. I won't go into them all, but there's a lot of traditionally successful indicators that are saying that it's true. And it always feels like a soft landing kind of before it's not. And so this is like mentions of soft landing on Bloomberg. And you can see like really spiked before we actually had recessions in 2000, 2007. So everyone's debating.
Sorry, Tom. Sorry. Can you just explain, just for the clients, what you mean by a soft landing as opposed to a hard landing?
Soft landing is basically saying, so we showed the growth barometer. So growth is slowing down, and it's slowing down under the impact of higher interest rates. So that's what inflation's too high, economy's too hot. Central banks come in and raise rates to try and cool the economy and inflation. They're winning on both fronts. They're definitely cooling the economy and they're cooling inflation. But it's, we're talking about big economies. It's not, it's hard to feather the brakes like you are in your car. They've jumped on the brakes. Everything's slowing down. Are they then able to engineer, is the economy going to be able to withstand the impact of those rate hikes and then rebound and not enter a recession, like cool inflation sufficiently and just get growth to muddle along and then reaccelerate? But that's a soft landing. Whereas a recession is like we've jumped on the brakes. Yes, we've cooled inflation, but as a result of cooling the economy too much, it then tips into a sort of, recessionary cycle, which is traditionally what happens, by the way. It's very unusual to get this level and pace of rate hikes and not get a recession, because in essence, they need to now probably, given the slowdown in growth, they should be cutting rates to get growth to accelerate, because they're still worried about inflation. They can't do that. And so that's where we think the problem lies, is that given the stickiness in inflation, even though it's going in the right direction, by the time they feel they're comfortable to cut rates, it'll be too late to engineer that soft landing. So it doesn't mean we're having a big deep recession. We don't think that that's the case, but at some stage, where we've probably been wrong is the timing of that. And I'll talk a little bit further about why. But the resilience in the consumer in the US in particular, and the resilience in the corporate sector, given pent-up savings, robust balance sheets, means that they've been able to withstand a lot more in the rate hiking cycle than anticipated. I think a lot of people I think we're all a bit surprised by just how much the central banks have been able to put up rates. Remember, it was like, oh, we're ever going to get to 2, let alone 3. We're at 4. Yeah. And so I think they've gone a lot further. It's like, oh, wow, no, things are still okay. And so that's probably surprised, I think, everybody to a degree. And that means that the timing of the slowdown and the impact of those high rates has just been pushed out a little bit further. So we think we're sort of heading into the zone over the next 6 or 12 months where you will start to feel that. And we can see it in some of the data that is slowing down. And with things like default rates, so bankruptcies in small business, bankruptcies in larger businesses, we saw some of those banks in the US earlier this year actually collapse. So there are evidence of the impact of those rate hikes starting to be felt more broadly by the economy. So there has been this, default cycle started in the US. This is corporates defaulting on their loans, if you will. But again, we're not at levels associated with the end of a recession, right? So yes, the trend is not good, but we're still not at levels that are overly concerning. But again, that's something we're watching quite closely. Like if they continue to trend higher, that's indicative that those, higher rates are really starting to impact corporates and their ability to pay their debts.
It's expected to happen in an interest rate hiking cycle, though, isn't it? We're going to have some who can't afford to continue to repay.
That's normal. Yeah. That's right.
So where it goes is what you're saying.
Particularly given what preceded. You've got to remember, we're coming off an extended period of zero rates all around the world encouraged people and businesses and to take on a lot of debt with an expectation that rates were going to stay very, very low for forever, or at least a very long time. And then all of a sudden, the backflip that took place at the end of 21, where they were, oh God, we've created inflation, but now we've really got to get on the rate hiking cycle. To go from 0 to 4 or 0 to 5 in such a short period of time, it's the pace of that is unprecedented. And so we just feel that it'd be quite difficult. It would be a miracle if we're able to then engineer the slowdown in inflation and the pace of the rate hikes and not cause more damage to the economy. So there are parts, and I guess that's been the surprise. It's just given how much savings were built up in the system during COVID and all those fiscal handouts, people got a lot of cash from governments. We can see those savings dwindling now. People are running out of the build up. It just took a bit longer for that to wash through. But if you look at retail sales in Australia, they're terrible. They keep falling every month. If you look at retail sales in China, they're bad. They're starting to slow in the US. So there's evidence, I guess, that the consumer's starting to feel the impact. And here's the evidence that the corporate sector is starting to feel the impact in not being able to pay. And so it appears we're early in that piece, but we're now seeing us go that way. So it's hence why we remain cautious, I guess. Just taking a look at the long term now and some more optimistic conversation, I guess, if you will. But because not to be alarmist, we are generating reasonable returns. Markets are okay, and we are not yet in recession. So it's not here to sort of be alarmist. But if we look at the long term, picture of the world, we've sort of landed in our most probable scenario being what we define as return to normal. So the economy is essentially cycling now into that quite a mild recession, and then spend the rest of the decade in this long recovery with a more normal level of interest rates, which means better returns from traditional defensive investments, as you were talking about earlier, pretty healthy GDP growth. So some of those inflationary trends I was talking about, all of the capital expenditure required to green the global economy, decarbonisation, it requires a lot of spending that creates a lot of growth. So we think you're probably going into a more normal kind of growth, GDP growth environment, slightly higher interest rate environment, and that's a good thing from an investing perspective. So we're quite optimistic. So in that scenario, compared to the sort of post-GFC scenario where low growth, low inflation, low interest rates, we actually think you're sort of in a more normal scenario where you should get pretty healthy returns from growth and defensive assets out over the decade, and that's a good thing for diversified portfolios. In the negative camp, we've got, what sort of stagflation volatility. Essentially, this is saying that we don't get the inflation piece down and under control, like back to target and held there, and that inflation is sort of becomes volatile or sticky above target, and central banks have got to keep raising rates. It's going to, really mutes growth, but we get sticky inflation. We think that's a pretty low probability, given the trends that we're seeing at the moment, but it's certainly something that, just one eye on in case inflation reaccelerates, that's something that we need to consider. In the positive camp, and a new scenario for this year is what we've sort of coined AI boom. And essentially, that's the world experiences a productivity growth boom similar to the 1990s PC revolution. So our best estimates of what the impacts are, for those that haven't had a go, it'd be interesting to know how many people have Googled ChatGPT and asked it something, or to write something, or had a conversation with the machine. But in essence, think of it as sort of like personal computing. Pre the 90s, we didn't have a personal computer, and think about all the efficiencies that have come through having a computer. And then instead of having to write a letter and send mail, we then had emails. We had instant communication. Then emails have, obviously been taken over by chat messaging, and again, like more forms of instant communication. Well, think of AI as sort of like a personal assistant that sits there and helps you to, document and communicate and work more efficiently and effectively. It doesn't, we don't think, replace most people in the knowledge economy, but certainly helps to augment and make it more efficient and productive. Maybe there are sectors of the knowledge economy that will be replaced by AI. That's another conversation. But in essence, we think that boost to productivity drives higher GDP growth potential over the decade, which means stronger earnings, and it's a boom, right? Like it's a bit akin to what happened in the 90s. We had really strong economic growth without inflation because we had productivity growth. Again, we think that AI is going to contribute to growth. We think it's going to contribute particularly to certain sectors more than others. Is it going to lead to a full-on economic boom? Probably less. We think that's less likely, but we're certainly considering where it's more likely to benefit and impact.
So just to go back that one step, you mentioned volatility there is, from a probability, a little less likely. Why is that? Because we're starting to get inflation under wraps and we've got a normalized interest rate environment? Is that your reason for less volatility?
We think the cycle's sort of being reset here. So we came off the boom, we've had the rate hikes, we're slowing down now, we're getting a bit of a clean out, we're getting a normal interest rate environment brought back to us. And then post that, we're in an environment of investment and growth. And we think that that's sort of where we've had a bit of a reset, to be honest, over this last year in valuations and in defensive assets. Volatility is sort of saying that we just sort of shorten the business cycle where, we kind of, and potentially we're there, like it's still something we're attuned to. So again, thinking about, we sort of had COVID and then in came fiscal handouts and rate cuts and then created a huge boom. And then they went, we've created too much growth and too much inflation. Now we're going to jump on the brakes and slow things down. If the response to the slowdown is lots of stimulus next year, then welcome to that world where we're sort of on again, off again, depending on the cycle. So that's why we think about it, because we could be in that cycle, but we need evidence around that. Whereas given we get the sense from listening to central banks that I think inflation spooked them, and I think it spooked policymakers more broadly. Having not experienced it for such a long period of time as a problem, government spending money hand over foot, central banks printing money and cutting rates, not worrying about it, because it never really created inflation until it created way too much. I think they're all now scared enough to be hopefully a little more diligent in their policy making settings to not recreate that problem. So there you go. We're having some faith in policymakers.
There's a change, hey? Yeah.
Yeah, who knows? But we think, let's have faith for now and be optimistic that they have learned the lesson and we do get back to that more normal environment post the next year. AI boom. Yeah, so this one's quite interesting. Excuse the busyness really of the chart on the left, but essentially, so again, for those that have tried, or you might go off this call and have a try, ChatGPT, it's natural language processing. So you ask it a question, it goes and does its research, captures language, just analyzes it, comes up with an answer. So scrapes the internet for data. There's been evolutions of this. Each evolution, they expand the parameters of the algorithm and allow it access to more data, essentially, so it gets smarter and learns more. And so ChatGPT 3.5, which was the one that was out until almost the end of last year, is the black line, and this is its success rate on various exams, biology. The one that's really interesting is the bar exam. So this is the exam for barristers in the US to, be admitted to the bar. It's pretty challenging. It had a really low pass rate of 10. Everyone's going, this AI can't even sit the bar exam, like it's never going to replace lawyers. And then all of a sudden, ChatGPT 4, which was released, and it's only, it's 6-7 months old now. And basically, it's got a 90% success rate on the bar exam. So
we don't need lawyers anymore. Is that what it's telling us? Where do advisors fit on this, Tom? How long before we're not needed, hey?
Our view is in professional services.
Yeah.
The front office, so our role, your role, where we have to synthesize huge amounts of different information, relationships, understanding, ask the right questions, will be very difficult to replace. However, there's there's portions of our back office where we've already been using, data and analytics and systems and code stack and automation for some time. It's just that this now accelerates our ability to do that even more efficiently and do deal with more data. But it doesn't change any of the front office jobs for those interpreting it or communicating it, if that makes sense. So it helps us become more productive. In accounting, like audit surely gets automated, right? Because it's checking, one set of accounts with another set of accounts and matching it off. Like that to me does not require human intervention. And so it gets automated. The initial production of contracts in legal firms, you can ask it to write contract. Actually, that's a really interesting thing to do. Like a simple contract. Like Brendan and I want to bet that who's going to win the IMAP award, and if I win, then I get $10 from Brendan. Write us up a contract, and it'll go away and do like 90% of the work, and we only have to edit it afterwards. So it's quite smart in getting along a lot of the way there, but needs someone to finish it. Which is quite interesting. So it's definitely going to be, it's here to stay, and it will impact and enhance certain businesses, but it's probably the real impact from an earnings and growth perspective is going to be muted. Like it's been a pretty big boom in the short term, and that's really lifted equity markets over the last 6 months, but all quite a lot of hype. And the chart on the right is just to kind of, douse a little bit of cold water given the performance of some of those stocks year to date. This is Amazon in the 2000s boom, and you can see the stock price, really going from nothing to a peak of sort of $5. And then by the end of 2001, had given up 95% of its value. Now it's one of the most valuable companies in the world 20 years later. But as an investor that bought the hype, you wore an awful lot of pain before you got back all your money and some. And so, as I showed earlier in the chart, the growth in these businesses is all being valuation expansion, not earnings driven. And when they talk in their earnings updates, they're saying, yeah, it's coming, but it's like 10%, next year, or 20% over 2 years in terms of the benefit, which is a fantastic benefit in earnings. But if your stock price has doubled or gone up 80%, it's probably gone a little bit too far in the short term relative to what the real impact is going to be. And so we're just a little bit cautious. We do own through the managers, Affinity, GQG, and the index indeed. There is a decent exposure to these tech stocks in the portfolio as it is. So we don't need.
We're not going overly hard as a result of the potential of what GPT will do, based on what you're saying there with Amazon. Is it? Yeah.
It's arguably still one of the biggest themes in the portfolio by definition of these companies being so big and they're being held by those managers. We just don't need to go any more than that, if that makes sense. Yep. Yeah. So you're participating, it's just not all the portfolio. It's never sensible to bet the farm on everything on one idea, right? So
correct. Yeah.
Valuations, as a result, again, of those tech stocks we're rating, this pink dot, which is the current valuation of US equities, is now back at sort of 20 times. If we look at the NASDAQ, which is the tech stocks, it's actually up here in the 30s again, and has become quite expensive relative to long-term at sort of 15 times. But the rest of the world's okay. We think this is part of the reason for that return to normal positive outlook, in that over the long term now, we expect to generate good, healthy returns from equities. And in US equities, we think there's growth there. It's not negative, but we're just a bit cautious short term on the valuation and the price you're paying for some of those assets. But the big one really, when we start thinking about building diversified portfolios, is it relative to the defensive part? So equities essentially relative to bonds or defensive assets are looking expensive, and we'll unpack this a little bit further. So I guess we're overweight a bit of the defensive assets because they're better value and they're actually giving us good returns versus the growth parts of the portfolio. So holding more of those is not necessarily punishing the overall return of the portfolio as we go forward. Earnings, just quickly, earnings are flatlining here in Australia. So the squiggly lines, blues 22, greens 23, pink's the forecast for 24. They're not going up. They're forecast at best to be flat. And so again, if we're getting good income stream from defensive, Australian corporate bonds, and that's not a bad place to sit if we're not actually getting earnings growth from equities. Similar story in the US, 23 is flat, or actually now below 22. So just again, this is reflective of that slower global growth chart that we kind of got back at the beginning. Growth is slowing, so are two of the earnings divisions, and really to get really bullish on equities, growth needs to be re-accelerating, and with it, earnings, because ultimately we're, as shareholders in businesses, want to earn higher profits over time. So that's
your expectation from all asset classes at this stage, whether it's shares or bonds or whatever, it's more an income play than a potential growth upside.
We think so, yeah. Given the boom that we've seen in equities year to date, we've captured just a bit of that. We missed a little bit Q1, but we've certainly, over the journey, captured quite a bit of that. We just think the expectation for it continuing to grow at that rate, it's a bit capped on the upside. So
yep, a bit risky.
Dividends, income, coupons, etc., are really going to drive the return, in at least for a little period of consolidation.
Okay.
So, we did add some equities back in March at the sort of worst of this was the sort of decline when Silicon Valley Bank went under. So global equities and Aussie equities are down, 6, 8, 10%, depending on where you were looking. And so that was an opportunity for us to buy after that, sort of missing some of that early March rally. And that set the portfolio up to have that better quarter since then, if that makes sense. So you can see, show the performance. That's because we used that volatility to advantage to deploy some of that cash. And then following the strategic asset allocation we do, again, because we're long-term more positive on equities, there's been a slight increase in the neutral allocation to equities. And so we've added a little bit more there.
So just as a reminder, just go back if you wouldn't mind, Tom, just as a reminder for clients, when you talk about SAA review, the strategic asset allocation, which is that longer term outlook view. And then throughout the year, we talk about the TAA, which is our tactical asset allocation, where you'll make minor changes along the way to your long-term view.
That's right. So generally to try and preserve capital, so minimise the drawdown, we'll step away from that long-term neutral position. If it's balanced, which is 50 growth, 50 defensive, we might have shifted it to 45, 55, for example, just to protect on the downside. We have used some of that cash that we had to re-enter markets at better prices. That's meant a better quarter, or better 4 or 5 months since. But we're still overall somewhat underweight versus our neutral, but less so, right? So I think if you're talking about the 70-30, we're at 66, or the 50-50, we're at 46. We're only 4% under that neutral. Again, there is that potential for a soft landing. We're not as bearish, I guess, but we're mindful to the risks. And if we do start to see, as I said earlier, things like the corporates defaults pick up or continued weakness in the consumer sector, that may cause us to become a little more defensive. But we feel like we're in a nice position where we're capturing that sort of trend in markets. The portfolios are generating good overall returns, whilst we're still sort of not over our skis. We're still, high quality. We don't own small caps or risky parts of defensive assets, or we're in blue chips. We've got lots of liquidity, and we're sort of we feel like in a good balance for where the market and the cycle is at this point in time. So neutral Australian equities, the valuation we showed earlier is reasonable. You get a dividend yield, slightly underweight bonds, but these were strong underweight, and we've used sell-off to add to just be slightly underweight. And we've been deploying some of the excess cash that we still have a lot of cash in portfolios, but less so than we had, as we've been buying more of these bonds. And we expect to continue to deploy this cash into those assets over the coming months.
Just on those, before you go into the yields that we're capturing, and it might be a good time just to talk about, I know we spoke about alternatives as an asset class within the portfolio. So perhaps if you could just maybe give us an example of what an alternative asset is, and then how are you implementing those into the portfolio, if at all?
Sure, great question. In this world where everything is largely daily priced or liquid, alternatives we define as, in our global alpha bucket, are some of the essentially hedge funds, and we have owned them and still do own some in the portfolios. And we may have spoken about in previous episodes, but there might be market neutral strategies, so they're not dependent on the market going up or down to generate money, but the relative movement between certain stocks and the skill of the manager in picking that relative movement And they for the last few years, when interest rates have been low and the expected return from traditional defensive like bonds have been low, we've used them to diversify the portfolio and to deliver positive returns. And that done largely, they did that job quite well last year. Some of those funds are up 6 or 7%. Now that we're getting paid, we'll show you the yields, better returns in the defensive parts of the portfolio, there's less need to have those strategies in there. So we have been progressively selling them down in favour of traditional defensive investments or diversifying investments. So from an opportunity standpoint, we're now seeing probably better opportunity in traditional assets as opposed to alternative assets. The second piece, and I think I'm going to tie this in because there's a question relating to corporate or commercial property
commercial property, yeah. Anthony's asked.
And real estate, we're pretty light on in property. We have so in the strategic asset allocation review, the neutral allocation came down. It is like global property is really like 2 or 3% of portfolios. It's very, very small weight now, partly because of those concerns. I did look at Dexus's result this morning, which was your question specifically. And the write-downs were material, but they were sort of like 9% in office and 17% in industrial assets. So big markdowns in valuations. And we think that process is really only starting, because to do that, they've adjusted the yield, the cap rate on those assets to 5%. Now, 5% is still only, basically 1% above the 10-year government bond rate in Australia at 4.2. Traditionally, that's like 3% spread. So arguably, adding, they've only increased the yield by 0.5% when actual yields have gone up, 3. It's sort of, they're slowly bleeding it out, if you will. And we just think that process has got further to run. So, and that's a global issue. So we're saying, finally, we're seeing devaluations in the commercial property market coming through from groups such as Dexus and Charter Hall. Similarly, with the industry super funds are starting to market down, we're seeing that issue globally. And that's probably slow-moving valuation is quite, outside of everything we do is daily price to the market is deciding on the valuation. So you're buying a real valuation every day. In a lot of alternative assets, property, commercial unlisted property, private equity, the valuation process is quite slow. And so we are concerned that there's elements of the global alternative market, private equity and unlisted property, for example, that are still a bit behind on getting their valuations up to where we are. Think about last year, tech stocks down 35%, equities down 20-odd%, all those kind of big sell-off in the listed markets, really only just getting started. Like Dexus marked their property down by 9% today. Okay, we're getting there, but versus
we see that flow through into the likes of the industry super funds, and because they manage property for them as well, so that eventually flows through. So you'll start to see more and more of that going on, but arguably the listed market may be overshot a little bit. So global, listed property down 30 or 35% in some instances. And then maybe the real asset market comes down, 15 or something. And so maybe listed property gets to actually rise a bit from here, and commercial, and the unlisted piece comes down a little bit further. But so I would say in terms of alternative assets, in the liquid form that we look at, less attractive than they were relative to traditional defensive assets. Yeah. And in the unlisted world, private asset world, be careful, because I don't think the valuations are quite up to date yet. Yeah. Getting there, that will be a place maybe to look next year once all those valuations have washed through. Yep. Thanks, Tom.
No worries. Yields. And these are the actual holdings across the sort of portfolios from the defensive side.
Yeah, so sorry, Tom, make that clear. We hold all these particular funds in our portfolios, agree? Yeah.
That's right.
These are the expected or the current yields on each of those funds.
That's right. So RBA cash rate at the moment is 4.1. We own a cash fund that's paying, invests in term deposits, but and is delivering just above that at 4.3. That's the mutual cash fund. We also own Aussie government bonds via Vanguard. That's got a yield of 4.2. Global bonds at 4.9, PIMCO, and then there's an ETF at 6, and then Realm at 6, and Jane Tree at 6.4. So the corporate debt, that's these three funds, is delivering 6 and a bit. The government bonds are delivering over 4. These have the advantage of actually, in really bad environments, the yields fall, which makes the prices go up. So if we had an environment where we did enter a recession, you would see you get the coupon plus you might get another 5% capital. So you might get like a 10% return from these assets in that environment. That's pretty attractive as a diversifier to your equities. And then you're obviously still getting a meaningful return versus where we were, at least from cash. So we look all across this sort of spectrum, and we think 6s is not bad. Yeah. And then your equities hopefully continue to go over the long term. We feel like this helps to build up a good high single-digit return profile from your traditional diversified sort of balanced and growth portfolios, and that we think that's a great outcome, and that's more akin to long-term averages, to be honest, which is fantastic.
So that defensive portion that we've been overweight, we're starting to get some benefits of that going forward.
Absolutely.
Yeah, it's a good question and a good discussion because, obviously in the last number of years, it's just been challenging to get a decent return out of a big portion of the client's portfolio. And we quite often talk about that, but then we see such a rapid rate rise in the last 12 months that we haven't seen that yet flow through into the portfolio performance because of that duration issue. Do you want to talk a little bit about how that sort of works and why we've had to wait before we start to see some decent yields flow through to the performance?
Yeah, I mean, these ones on the right are what we call floating, and these is what we call fixed. So fixed are like long-term, so they pay a fixed coupon, and over say a 5 or 10 year horizon, and so when the market rate of interest changes, the value of these bonds change to make the yield higher. So you've kind of got to reinvest into the sell-off in order to achieve the higher returns going forward. So that's the duration issue that you spoke about, whereas these reset on a monthly or quarterly basis to the higher market rate of interest. So you've got to sort of wait for, one, all the rate hikes to come through, and two, for the components of that portfolio to roll over on, completely to reset to that now new high yield. And so they've basically done that now, where cash rates are 4 and the current yields are 6. They've been for the last 6 months rolling monthly, quarterly, what have you, and they've reset themselves now to that new go forward yield, which is really attractive. And look, it's happened really quickly in hindsight over the last year. But it just takes that, 6 months for it all to kind of flow through, if you will, to what it means now going forward. So pretty attractive.
That's part of your risk mitigation too, in that you have short-term durations as well as medium and long-term to be able to capture or protect, depending on which way rates are going. Is that part of your risk mitigation, to have a real blend of different?
Yeah, absolutely. When government bonds were down here in sort of 1 to 2, we had very little, because the risk was this happened.
Yep.
And you lose money on the other side in that fixed rate reset. The duration gets you on the wrong way. So we had very little. And as they sold off last year, we've sort of progressively, really from about 2.5 up to here, we've been layering in and rebuilding that exposure. And the reason is, as you say, and I sort of was discussing earlier, on the other side, if the world does go into recession and rates come down again, then the capital value, which has gone, has been selling off, essentially goes up. So you can get, the 4.2 comes down to 3. That adds about 6% in capital growth terms to the return of the bond, which is a 10% total return. That's at a time generally when your equities are falling, because you're in that sort of recession environment. So it gives you that offset. Whereas in these floating rate strategies, you don't lose the money on the way up, but you don't make the money on the way down. But what you do get is a nice high sticky coupon, which is quite attractive. And so you want it's nice to have a blend of the two for those purposes.
Yeah, it's positive news for our clients. Yeah, it's great.
Absolutely. And with that, I think,
Covered it.
yeah.
Well, you've clearly done a good job of explaining, because we only had the one question from Anthony, which we've answered. So, Tom, as
Fantastic.
always, thank you. For our
Pleasure.
clients, if you are looking to have another look at this, we will put it on the website, the whole presentation, so you can have a look at it again at your leisure. But in the meantime, obviously, if you do have any questions, don't hesitate to reach out. But Tom, thank you. And we look forward to seeing you in Sydney next week and see how we fare at the IMAP Awards.
Good luck.
And yeah, to our clients, thanks again and for tuning in. We appreciate you taking the time, and we look forward to chatting soon.
Thanks, everybody.
Thanks, Tom. Bye for now.
Bye-bye.
Bye.